Today, I want to walk you through what's happening in the equity markets as of April 15th, 2026, what it means for your portfolio, and most importantly, what we've already done about it. Coming into 2026, things actually looked stable. Strong employment, steady spending, and markets were calm. But by late February and into March, that changed quickly. Geopolitical tensions increased energy prices, they surged, and markets reacted fast. We saw a meaningful pullback across global equities and a sharp shift in investor positioning. One of the biggest changes has been what's leading the market. For years, it has been large cap US technology companies. That momentum has now slowed. We're seeing capital move away from mega cap tech and toward value, quality, and defensive sectors like healthcare and utilities. Globally, it's been more mixed. Canada has actually held up relatively well, helped by higher energy prices. Europe has been weaker, China is still slowing, and commodity-driven regions have actually benefited. Now, this is important. At the start of the year, markets expected interest rates to fall. That's no longer the case. With rising energy costs driving inflation, bond yields have moved higher yet again. The US 10-year is now around 4.3%, and the conversation has shifted from when rates will fall to how high they may need to go. Commodities have been one of the big winners. Oil moved above $100 a barrel, but interestingly, gold did not behave as expected earlier in the year. As interest rates rose, gold actually declined, showing that even traditional safe havens can struggle in this environment. Now, let's talk about your portfolio because this is where it matters most. While many investors were still chasing returns early in the year, we reduced risk. In early January, we trimmed our highest risk strategies and introduced a market-neutral position designed to perform independently of the market direction. Shortly after, we made similar changes in our pension portfolios. We reduced US equity exposure, and we added defensive assets like utilities, treasuries, and gold. When volatility hit in March, those decisions really mattered. We had less exposure to the areas that fell the most and more stability built into the portfolio. Again, as we moved into April, we shifted once more. After the pullback, valuations improved, so we started selectively adding back into growth, including US equities and global innovation strategies. Think of it this way. We built the protection first, and now we're redeploying that into opportunity. As we look ahead, the easy gains of the past are more likely behind us. This is a more complex environment, higher volatility, higher interest rates, and more frequent shifts in leadership. But this is exactly the type of environment we are built for. Our goal has never been to chase every market high. It's to protect your capital, avoid major drawdowns, and grow your wealth consistently over time. We acted early, we protected when it mattered, and now we're positioning for what comes next. We'd like to thank you for your trust, and as always, we're here if you need us.